All right, so what we're going to be talking about this morning for the next probably 45 minutes or so are the new regulations that make certain possibly abusive basis shifting transactions into disclosable transactions of interest. So as a matter of background, under the new Treasury regulation section 1.6011-4A, every tax, well, that's not the new one, that's just a regular rule. Every taxpayer that participates in a reportable transaction has to disclose the transaction. Importantly, the regulation says that just because a transaction is a reportable transaction doesn't necessarily mean that it's improper, right? It's just something that the IRS has identified as something you need to disclose because there's a chance that it could be abusive. The IRS decides it's actually abusive, then they would attack it as lacking economic substance, most likely. So a reportable transaction includes, among others, a transaction of interest, which is simply one that the IRS has identified as being a transaction of interest in guidance published by the IRS. There was some discussion when these regulations were first proposed that maybe they exceeded the IRS's statutory authority. So I found that interesting that the final regulations go to great length to explain how the IRS has the authority to issue these regulations. And it's also just a disclosure requirement. It's not really creating new substantive law. So I don't really think there's a huge risk that under the new Looper-Bite decision that this would get attacked as exceeding authority, but that had been said earlier. Just wanted to mention that. Okay, and then on June 28th, I mentioned they proposed the regs. They were finalized on January 14, so about a month ago, a little less. What do the final regulations say? Any taxpayer who participates in one of the 4 enumerated types of basis shifting transactions or a substantially similar transaction has to disclose it to the IRS on the appropriate form for disclosing transactions of interest. And that form is sent to the Office of Tax Shelter Analysis. So of course, that's going to increase the chances of that return getting audited. All 4 of the potential transactions of interest that are possibly abusive involve efforts to shift basis among related partners under sections 732, 734, and 743. The regulations go through quite a bit of detail describing who participates in a transaction that's reportable. So it can be either the partnership or a partner. The key threshold is that the partnership has to have either immediately before or immediately after the transaction in question related partners, right? They have to be related under the rules and the regulations. And if you don't have 2 related partners either before or after, then these rules don't apply and you don't have to disclose anything. If you do have 2 related partners, then either the partnership or the partners may have an obligation to disclose either because a partner received a distribution of property that resulted in a basis increase, or the partnership distributed property or had a partnership interest transferred in that partnership that resulted in a basis increase. So either the partnership or the individual partners may have the disclosure obligation. Oh, and in a sort of a look back rule, there's also the ability to participate if a taxpayer receives a property or a partnership interest in a transaction that would have been a transaction of interest or a substantially similar transaction. And that one's kind of interesting because the taxpayer may not always know that the previous transaction could have been a transaction of interest. I think there's an assumption that because it's involving related parties that of course they're going to know because this was a scheme. But if you don't know necessarily that it was an improper basis shifting transaction, it's probably not a scheme. And it doesn't really need to be disclosed, but that you could miss something that should be reported if you didn't know that you received property or a partnership interest in a transaction that previously would have been reportable. So watch out for that. Related partners, I'm not going to spend a huge amount of time on this. It's the 267 or 707B1 rules with some modifications. I've listed out all the, potential related persons in here for your perusal in the notes. There they all are summarized. I'm not going to go through the entire list, but it's, the usual suspects, people who are, control closely held businesses and grantors and beneficiaries of trusts and estates and, people who own directly or indirectly tiered partnerships where it's really the same set of owners. The constructive ownership rules are applied in determining who's related, again, through tiered entities, partnerships and trusts. The beneficiaries and the owners can be treated as owning partnership interests or stock in entities that are transferred by utilizing the constructive ownership rules. It's sort of beyond the scope, but they apply. Okay, here's what I really want to talk about. What are the new basis shifting transactions of interest? All right. And again, the key threshold is it involves a partnership with two or more partners who are related under the 267B rules, right? So what are the transactions of interest? These aren't the order they're in the regs, but I'm going to go through them in this order because I think it makes sense kind of analytically to start with 732B since it impacts some of the later transactions, right? So first transaction of interest. Partnership distributes property to a related partner in complete liquidation of the partner's interest or in complete liquidation of the partnership. And the basis of the distributed property is increased. Transaction 2, the partnership distributes property to a related partners in a current or liquidating distribution, and the partnership increases the basis of its remaining property under 734B, right? The common adjustment to partnership basis. A partner transfers all or part of a partnership interest to a related partner in a non-recognition transaction, and a special basis adjustment occurs under 743B. This is, I would think, probably one of the more rare situations, since in most cases, a 743B adjustment is going to happen when there's a sale, but this only applies to a non-recognition transaction. So we're really thinking about 721A, 351A, most likely. And last one, partner distributes property to a related partner. The basis of the distributed property is increased under 732D, which is an elective rule. And the distributing partner received all of its partnership interest in the last 2 years in a transaction that would have resulted in a basis increase had a 754 election been in effect. This is probably another one that you see less because that's mostly an elective rule, and we'll get into that in a second. Really important, and this was a change from the proposed regs. The proposed regs had a 5 million disclosure threshold. Now the disclosure threshold is 10 million. So you don't have to disclose the transaction, even if it's one of those four or something substantially similar, if the applicable threshold of 10 million is not satisfied, okay? So what's the applicable threshold? It's the sum of all basis increases that result from the transaction, by the way, without reduction for any basis decreases that occur in the same transaction, okay? It's not netted. Over the amount of gain recognized from those transactions on which tax is actually paid. Now that's interesting because it's just not just the amount of gain, it's the amount of gain on which tax is paid. So if you have a tax indifferent party that doesn't actually pay tax, even though the gain is recognized, think somebody with NOLs, unutilized loss carry forwards, a tax exempt organization, you don't get to reduce that, your basis increases for recognized gain if the taxpayer doesn't actually pay tax for some reason, okay? And in the case of 734B, it's computed only with regard to the basis increases to related partners, right? Because the 734B adjustment is to the common basis of all partnership property. So if we did the common basis of all partnership property, you might easily get to the 10 million. But in this case, the IRS is nice and says, well, no, we really only care about the related partners. We don't care about unrelated partners. So the 10 million is only for your related partners. And same thing under sort of 732B, only the basis increase in property distribute to related partners, of course, excluding any decreases and excluding any tax in different parties. Once again, we're only worried the 10 million threshold is about related partners, not about unrelated partners. All right, let's go and discuss these a little bit more in detail, starting with a quick review of some of our favorite sections of subchapter K. Under section 732, as of course we all know, normally a partner's tax basis and property distributed to the partner from the partnership is the partnership's basis in the property before distribution. Exceptions, 732A2. The partner's adjusted tax basis in its partnership interest is less than the basis of the distributed property, then the distributed property receives the partner's outside basis, right? So it's that outside basis, either limitation or increase that results when you distribute property to a partner that has an inside basis different from the partner's outside basis. And then 732B, the partner's tax basis and property distributed in complete liquidation of the partner's interest or of the partnership equals the partner's outside basis immediately before the distribution, reduced by any money. So similar rule, right? Where the outside basis differs from inside basis. The basic theme of all of these transactions is that there are outside-inside basis discrepancies. And we were manipulating 732, 734, and 743 to shift, basis from one property to another. And the second property is the property getting a basis increase is depreciable. Oh, and yeah, 732 provides rules for allocating. So how does a transaction work? All right. A partnership with two or more related partners makes a property distribution to one of the related partners in complete liquidation of the partnership interest or complete liquidation of the partnership. And there's an outside basis discrepancy, right? So if the inside basis is less than the outside basis, under 732B, the distributee's basis in the distributed property is set equal to the outside basis. All right, so the outside basis is increased by the amount of that excess, and the distributed property is eligible for additional cost recovery deductions like depreciation, amortization, bonus depreciation would be the most abusive probably, although the 100% and 80% is gone. It might come back, we'll see. And that's really where the abuse comes in, right? To related partners, we shift, basis from a non-depreciable asset to a depreciable asset. We get new depreciation deductions we wouldn't otherwise have received. And there's really no economic substance because the partners are related, right? The same people ultimately own all of the partners in the partnership. So I gave my example. Appropriately, I'm using Lord of the Rings because I'm Frodo of the Nine Fingers today with a broken finger. Assume that Aragorn, Gimli, and Legolas, who are all related to one another, form Fellowship LLC, which doesn't elect to be a corporation, and they contribute some assets. And this example will continue, right? So they're going to contribute Gondor with land with a fair market value of 30 and basis of 10, Minas Tirith, which is a building, depreciable on a straight line basis over 40 years. It's commercial rental property, let's call it, and that has a fair market value of 120 and adjusted basis of 80. Gimli is going to contribute Moria, vacant land, not depreciable, with a fair market value and adjusted tax basis that are equal, both at 150, and Legolas puts in 150 cash. There's an operating agreement that says everything is 1/3. The allocations have substantial economic effect, and we're going to make a 754 election. All right, so we have a 704C issue. So because of the ceiling rule, Gimli and Legolas get all the depreciation. What that's going to do is after 10 years, and I'm assuming no debt, so we don't have to deal with debt allocations and limitations related to allocations because of debt. So we can take all that off the table. So after 10 years, what's going to happen is you're going to get these big inside-outside basis discrepancies because of the 704C. Now, and assume in this and all the following examples that the applicable threshold is met. Okay. Even though, if you just did the X numbers, you have to assume X is a number that gives you a multiple that gets you to the threshold. So after its 10th year, so we're avoiding the mixing bowl rules, the 737. They're going to distribute Minas Tirith, which is the depreciable building, to Gimli in liquidation of his interest. Gimli is going to take a basis in Minas Tirith, the building, equal to the outside basis. So the basis gets increased by 80x, and Gimli gets an additional 2.67x of depreciation deductions that wouldn't have been available otherwise, right? And again, these are all related parties, right? So pretend that Aragorn, Gimli, and Legolas are siblings, or dad and his kids or whatever, and it's all sort of the same family pie. And so there's really no real economic substance to it, because we're creating new deductions for basically the same ownership group. Or, even worse, it's like dad and two trusts that dad created, something that'd be the most abusive kind of transaction, right? All right, so 734, we're moving on to our second type. Normally, under 734A, the partnership doesn't increase or decrease the basis of its property when it distributes property to a partner. But as we know, if there's a 754 election or a substantial basis reduction, we do make an adjustment to the common basis of partnership property on a distribution of property to a partner. We're not going to talk a whole lot about substantial basis reduction, because these rules are mostly about transactions that increase basis, and that usually doesn't happen in a substantial basis reduction. But it's in statute, a reminder that it's there. So the amount of the partnership's adjustment to its inside basis, we have a 754 election in place and you distribute property, is either the amount of gain recognized or the basis adjustment taken into account by the distributing partner under 732, which is what we mentioned, 732 earlier, right? So that's that adjustment when the basis of property distributed gets adjusted to the partner's outside basis. 755 provides the rules for allocating the basis. All right. So how does this transaction work? We mentioned there's a 754 election and related partners. We distribute property to a related partner. Again, we have an inside-outside basis. Mismatch, inside basis in the property exceeds outside basis. Under 732A or B, the distributing partner takes a basis in property that is lower than the inside basis of the property, right? So we have a basis decrease to the distributing partner, which means that the partnership gets to increase the basis of its remaining property. The partnership then is able to claim additional cost recovery deductions. So our example, assume A again, we're dealing with the Fellowship of the Ring. We're after 10 years to avoid mixing bowl. Fellowship distributes vacant land to Aragorn, not the depreciable property, the vacant land, not depreciable. So Aragorn recognizes gain because his tax basis, because the tax basis of the distributed property is greater than Aragorn's outside basis. So he recognizes gain on that distribution. And because Aragorn recognizes gain, the partnership gets to increase the common basis of partnership property. When it does that, we get to allocate it under 755. We had Gondor had a 704C built-in gain, so part of it goes to Gondor, which is vacant land, and the rest we can put to our building. And so we get new depreciation of 1.33x in this example. Not quite as much as the previous one, again, because in my example, you had to give it first to the, well, not first, but you had to also give part of it to the other appreciated property of the partnership under 755. But still, we get some extra benefit to the other partners in this partnership because we took Aragorn out with appreciated property. And so we got to, bump up the basis of our inside basis and get more depreciation for related partners. All right, 743, right? Partnership doesn't normally adjust the basis of its property on the sale exchange of a partnership interest. But if there's a 754 election in effect, the partnership gets to increase or decrease the basis of its property. The basis increase under 743B, unlike the 734B adjustment to the common basis of partnership property, the 743B adjustment is only specific to the distributee partner. So it's the special basis adjustment that isn't really part of the partnership's allocations. I love section 43 adjustments in like private equity type transactions, because then you don't have to deal with 704C reverse 704C allocations and whether or not fighting over the remedial method. It's much easier just to do a 743 so the buyer gets their extra basis without affecting common inside basis. So you have 704C fights. just to decide. So 755 again applies an allocation. Importantly, this is a change also from the proposed regs. A transaction resulting in a basis increase under 743B because of the death of a partner is not disclosable, which I do find interesting because if you had Aragorn, Gimli, and Legolas's example before, and it's dad and his kids, and we're manipulating, we're creating those inside-outside bases so that when dad dies, he gets a step up. That still has the same abuse potential that they're worried about. So it's interesting that we've removed death from transactions of interest, but they did. So in their infinite wisdom. So what happens in a transaction that creates basis shifting under 743B? Same thing. We've got a transfer of an interest in a partnership with the 754 election in a non-recognition transaction. So this is going to be a little unusual. We're talking about 351A, 721A primarily. The transferee partner's outside basis will generally equal the transfer partner's outside basis under the rules of non-recognition transactions. But if there's an outside basis disparity, then you get a special basis increase to the transferee partner, notwithstanding that you actually don't pay any gain, and the transferee partner gets extra depreciation, amortization, or other cost recovery deductions. So assume example A, and we're sort of going to plug numbers rather than do my 704C manipulation example. Assume Aragorn contributed 90x of cash, not the property. The property was purchased for 80. Assume at the end of year 10, there's an outside basis. Aragorn has an outside basis of 90. Gimli has an outside basis of 150, and Legolas has an outside basis of 150. And every partner's share of inside basis is 130, and the fellowship has 170 of cash. So Aragorn contributes his interest in Fellowship LLC to Rohan. It's a corporation in a 351A transaction. There's a 754 election in effect, so we get a basis increase. Rohan Inc. gets a special base adjustment of 40. And I guess assume also Rohan Inc. is, I think Aragorn totally controls Rohan Inc., right? It's a related person. I don't think I have that fact in there, but that's supposed to be in there. And so there's a 40x basis adjustment, and that results in an extra 0.5x of depreciation to Rohan. Again, it's a non-recognition transaction. Nobody paid tax. These are totally wholly owned, controlled corporations. And we just sort of out of thin air created 0.5x of additional depreciation. 732D applies in a fairly unique, narrow range of circumstances only to partners who received all or part of their partnership interest in a transfer with respect to which a 752 election was not in effect, and they receive a distribution of property either within 2 years, or if the fair market value of the distributed property is, it should be 110% or more of its adjusted inside basis. Mistake typo, sorry. So how does a transaction work here? Partnership with two or more related partners makes a liquidating or current distribution of appreciated property. The related partner had acquired its partnership interest in a transaction that would have been one of the other 3 types of enumerated basis shifting transactions had the partnership made a 754 election. So the subsequent property distribution is made within 2 years, so 732D applies, or it's 110% more. The fair market value is 100% more. And then, so adjusted tax basis of the distributed property is chief-read is equal to the adjusted basis the property would have been had the 743 adjustment occurred. So then from here on out, it's just the same as a 740B, right? 732D is just a mechanism to treat, right? 732D just treats a transaction that would have resulted in a special basis adjustment under 743B as being a transaction that does result as special basis adjustment under 743B. So you can just refer to the previous example for how you get 1.5x of extra depreciation deduction you wouldn't otherwise get. Okay. Disclosure. What do you have to disclose? All right. The names and tax ID numbers of anybody who participated in the transaction, including related subsequent transferees. So if then somebody gets the property and like distributes it to somebody else who's related, you got to tell them who that person was. The basis, it's obviously the most important rules, how the basis got adjusted, either under 732, 734B, or 743B. And the federal income tax consequences, if any, realized during the taxable year, or any additional cost recovery deductions that'll be recovered in later years, right? It's the information that the IRS would like to know to decide whether or not they think the transaction truly is abusive and lacks substance. 6-year look back period. This is an interesting one. So if a taxpayer engaged in a transaction that becomes a transaction of interest after the year during which the transaction occurred, and the statute of limitations on the assessment of tax is still open, then it's still a disclosable transaction of interest, right? So if you have a 3-year statute, you might have a 6-year statute if there's fraud. If you have an open statute on a transaction that is now one of these, then it's disclosable. However, the applicable threshold is increased to 25 million. Right? So you have to have a 25 million basis adjustment increase in excess of gain on which you actually paid tax during the 6-year look back period, right? So it's 3, and the statute still has to be open, right? So it's 6-year look back because you have the 6-year fraud statute, but normally you'll have the 3-year regular statute. So if anybody did one of these in the last 3 years and it was more than 25 million, it's a pretty big number, then it's disclosable, right? I think the most common place you'll see this, like either is and it was interesting, it was in the proposed regs, it's missing from the final. In the proposed regs, they said, well, the IRS is going to issue a rule that treats 2 corporations, part of the same group filing a consolidated return, as being one partner. Like, because that's one place you see a lot of this, is using corporations within the same consolidated group that file consolidated returns, sort of shifting basis back and forth among another to generate extra depreciation in the consolidated return. And the proposed regs said, oh yeah, the IRS is just going to say we ignore those. They're all just treated as one partner. And that rule didn't make it into the final regs, and there's no mention of it. And nothing's been proposed. So that's gone. So that's one of the areas where you see this the most. The other area you see this a lot is like sort of the family partnership situations where, you know, you have all the dad and his sisters and cousins and kids and trusts, and they're all moving basis back and forth, from one another in order to generate extra deductions, but it's all kind of the same family pot they all share. And so if you have any of those situations in the last 3 years, it's 25 million. If you have any of those kind of situations going forward and you think it's potentially abusive and it's over the threshold, you might want to look at the transaction. But for the most part, again, this is sort of getting at potentially abusive transactions. And just because you do one doesn't mean it lacks substance, but it just has to be reported. So with that, I will hand it over to Conrad and Anna.
We're going to take a 5-minute break so Anna and I can set up here and stretch your legs. The one thing I want to say is I told you this was going to be really technical. And I will just say this about the basis shifting. If you represent a lot of family partnerships and you have a couple of 1031s that get contributed in and a son puts in cash, or you have cash on the other side, and before you realize it, you may step into one of these transactions, and before you never really cared much. And now you need to start paying attention to inside-outside basis, because going back to Kyle's rule, which I think is very unfair, if you look at Kyle's sort of notice and the partnership adjusted, if the first question we got back from the client was, can I sue the accountant because they put something wrong on the return? Right? Because it's never anybody's fault except the poor people that work on the returns, right? So that's why I wanted all of you to kind of look at these and these new really technical rules. Because if you think about Kyle's situation, you just had a partner recourse debt that was allocated to both, and all of a sudden you have positive adjustments and you're paying $1.8 million. And again, in the audit we're working on, there's no adjustment to the loss. The loss went to the right person. It's just the adjustment to the K1s and the debt reporting. And all these new rules are getting finalized. I don't know if anyone will be there to enforce them, but I just think it's a little scary, the volume of material that came out and got finalized before the change in administration. So with that, let's take 5 minutes and we'll be back at 9:35. Thank you.